Hello, everybody, and welcome to the Public Podcast. I'm your host, Kinsey Grant, here with you today to discuss Fed strategy and economic impacts in the wake of recent inflation, the banking crisis, fears over a debt ceiling standstill, all things macro. We are going to have a fantastic conversation today. It's going to tell you a ton about what's going on in the markets and what's going on in the broader economic picture today. Don't forget to like, comment, and subscribe to our YouTube at Public Invest and our Spotify at The Public Podcast for in-depth interviews to help you keep your portfolio on track. So with that, I am super excited to jump into things today with our fantastic guest. We have a lot of ground to cover, as that intro probably suggested. So to get started, welcome to our wonderful guest today, Cem Karsan, founder of Kai Volatility. Cem, welcome to the show. How's it going?
Good. Thanks for having me. Looking forward to the conversation.
Yes, as am I. And like I mentioned now twice, we do have a lot to cover here. So if you're ready, I think we can dive right in.
Let's dive in. Let's do it.
All right, let's do it. So let's start here with inflation. I think this is probably the topic at the forefront of a lot of the investor conversations that are taking place today. The consumer price index recently grew by 0.4% in April and increased by 4.9% annually, which is notably pretty high above the Fed's 2% mark that they try to keep inflation at, that goal that they have as part of their dual mandate. Now, investors have really been hyper-focused on how the Fed's interest rate strategy is responding to high inflation and is doing its best to tamp down on high inflation. I would love to get your read on how the Fed is doing and generally what its approach has been to rein in inflation that has been at 40-year highs for quite a while now. What's your take here?
Yeah, I have a bit of a different take than your kind of average commentator. If you think about the last 40 years, monetary policy has gone from the top left to the bottom right. Interest rates have dramatically decreased throughout that period. And that has been a function of the Federal Reserve lowering the Fed funds rate again and again and again in response to managing the business cycle. They were able to do that because they had two mandates that are given to them by Congress, which is to manage maximum employment and price stability. And they had created a virtuous cycle of disinflationary pressures by actually lowering interest rates. Why is that? Why were we in a disinflationary period? Why didn't we have inflation for 40 years? Well, if you lower interest rates, yes, that is stimulative cyclically, but secularly, longer term, it is actually disinflationary. Why? Lowering interest rates gives money to primarily corporations and wealthy individuals. Why is that? Who borrows money? Poor people aren't able to borrow money. Broadly, the majority of money lent and borrowed happens at the top with corporations and, again, investors. When that money flows to the top, to corporations primarily, what is a corporation doing with that money? They are lowering their costs, their profit maximizing entities, right? And they are maximizing their revenue. And that generally leads to globalization, which we had a massive period of globalization during that time, as well as technological development and advancement. So free market capitalism is essentially evolutionary free market, competition, raw and tooth and claw. Now, that's disinflationary. And anytime we had a cyclical, too far deflationary process, the Fed would come in and cyclically lower interest rates even more to kind of pump back up things cyclically. But the secular trend continued to be more and more disinflationary because of that. And that can keep on going forever in theory, right? Except we got to the lower bound, 0% interest rates. And during that 40-year period, which is a long time, what's called the Gini coefficient, or the distribution of wealth, got really, really high. It went from a 0.32 in the United States to 0.47, which is just a measure of how wide the disparity is between the rich and the poor. And that's the downside to monetary policy. It does actually create higher GDP growth, higher productivity in a lot of ways, and being monetary, like sending money to the top, because it creates more investment and growth. But it really, the money keeps aggregating at the top. And that can keep going for a while. But at some point, people on the bottom say, hey, that's not fair. What matters isn't total growth. Mean growth is median. Like, what is the real average person doing? If all the money's going to the top 1%, that's not fair. or equal or just, in generally speaking. So we're getting a response to that. It's been going on for about a decade. It started with the Tea Party and Occupy Wall Street. You may remember some of those things, and eventually flowed through politically to the left via Bernie Sanders and AOC, and importantly to the right. And Donald Trump is a populist, president. The rusted out cities in Middle America, the protectionism, right? All of these things are more leftist. So the left and right have moved dramatically left in the last 15 years. And eventually, what I was looking for was a spark, and COVID was that spark that led to dramatic fiscal stimulus. And a redistribution of wealth is happening in this country and globally. This is not just a US phenomenon. That rebalancing is inflationary. We've seen it through other periods of time. Why is it inflationary? Because if you send money to the bottom, 100% of the money that gets to the bottom gets spent. If you send money to the top, 100% of it gets invested. And that's a very different thing. So one is asset price inflationary. Monetary policy is asset price inflationary. Fiscal policy, generally when you're rebalancing it to the poor, is inflationary in terms of goods inflationary. So anyway, long-winded explanation, but important to understand the context. We are amidst a period of increasingly secular inflation. When we choose the route of populism and the rebalancing of unequal distribution, we lead to periods like the 1960s and 70s with the Great Society program, and that leads to much greater inflationary forces on a secular basis. So these cyclical conversations we're having, is the Fed going to lower inflation in the short term by increasing interest rates, is only part of the story, right? That is the short-term part of the story. Ironically, increasing interest rates is taking money from corporations, from technology, from growth, from globalization, and it's reversing a lot of the trends of the last 40 years and taking out the disinflationary secular pressures and replacing them with more secular inflationary pressures, even though cyclically it is dampening volatility. And I think that's the big takeaway. The pendulum has swung, and there are political pressures here that are ultimately driving a much more inflationary regime.
Yeah, it's certainly an interesting take. You started out by saying that you might not have the perspective that a lot of people in your position and peers and your cohorts might have, but I agree. I think that it certainly is different, and it's interesting to understand the longer term perspective when we're talking about something like the Fed. We have these FOMC meetings almost every month. There are many a year. We get a lot of interest rate decisions. The market typically has a pretty good idea of what those interest rate decisions are going to be. The Fed doesn't like to surprise us, but it is interesting to think that it's not just these one-off decisions about interest rates. It's a much broader strategy. It's a much bigger game that the Fed might be playing. And so I'm curious what the rest of that story is. You mentioned that this is just one part of the story. How else is the Fed going to try to play this long game to make sure that I don't even know if we can call it the markets anymore, the capital M markets are getting the medicine that they need to stay healthy? Tell me a little bit more about what the rest of that strategy looks like.
Well, I wish I could tell you that the Fed 100% understood or had a strategy to take into account the secular pressures that we're talking about. They are really in a bit of a bind, right? They had everything going for them such that they could very easily control the market and solve both of their mandates, legal mandates, with one tool in the short term. Unfortunately, in this type of regime, once they're having to deal with inflation and now their dual mandate is in conflict, they are much more in a box. They're much less in control of the circumstances. They don't really have the tool in their hands to fix the inflationary regime that we are entering. The only way to really control that is really to say, okay, we don't care about inequality, or that the situation that we're entering is not of importance, which is not up to the Fed. that is up to government. By definition, the government retains the power of the purse, and ultimately, has the say over where that money goes. And unfortunately, government, not unfortunately, I don't want to use that word. It just by definition is beholden to the people, and the people have decided, whether they understand it or not, that this isn't fair, and that we should have a more equal society. But if our objective is ultimately equality, or more equal, whatever that may mean, we now are wrestling with the fact that the most kind of the maximization of GDP or technological advancement or whatnot is no longer the priority, and that means a more inflationary regime. Mm-hmm. So to answer your question, I wish we could I could sit here and tell you the Fed could solve this problem. They have, if anything, exacerbated the problem by considering it a free lunch and solving the short-term cyclical problem for the last 40 years, while not thinking about the longer-term consequences of their actions. And that's essentially what they've been asked to do. The Fed was created originally to just, quote unquote, smooth the business cycle, right? That is why the Fed exists. We used to go from boom to bust before the creation of the Fed. And ultimately, the powers that be decided that we weren't willing to wait for crises to solve problems, which is what government in the United States was created, how it was created to work. We needed a faster solution. So the Federal Reserve was created. The problem ultimately is we've smoothed the business cycle, removed crises, and ultimately no longer fix the bigger problems or address them until they've gotten too big. So we currently sit in a place where we've been managing the short term, and the long term has kind of gotten away from us a bit.
Right. Yeah. And personally here, I don't envy anybody who has to make these decisions at the Fed. I don't want Jay Powell's job. It sounds like a difficult one. You know that the Fed has a ton of access to really fantastic data, but they still are operating on a lag, right? Where they get the inflation data, they get the employment reads, they get all this information, and then they make a decision, and then they kind of have to see what happens, I suppose is sort of the scientific way of putting it here. But in their transition, as the business cycle has gone kind of topsy-turvy and up and down over the last several months, the Fed has also had to shift its own position, shift its own strategy. Tell me a little bit about how quantitative tightening might fit into the Fed's broader playbook here. Explain a little bit about what it is and how the Fed might be putting this into play right now.
Yeah, the Fed originally only had one tool, which was to manage liquidity via interest rates. And over time, the problem that that has become apparent with that as the only tool is that it operates, as you mentioned, on a significant lag. When you lower interest rates, it takes a while for that to filter through to companies, to mortgages, to lending. A great example would be, we've raised interest rates from 0 to 5% in the last year. But multifamily home housing starts were up 22% last month. Why? Not because an increase in interest rates is forcing higher investment in real estate. Quite the opposite. That's from 12 months ago. Most of those projects were started before the hikes in interest rates started. So that's generally how things work. There's a 12 to 18 month, depending on what we're looking at, lag of how interest rates run through the economy and how they affect inflation. That's a hard tool to work with, right? When you're trying to get kind of a feedback loop on what's actually happening. What the Fed has done to more aggressively, kind of in more timely affect flows, and it really started again during the GFC, and slightly before that, but also really in earnest during the GFC, is using a tool called quantitative easing, or the opposite of that is quantitative tightening. That is essentially buying or sell or letting or selling. I mean, it's not exactly buying or selling. They're reducing or increasing their balance sheet, and buying or selling treasuries in the market. And that is a direct feed of liquidity directly into market. So much more firsthand, immediate effect outcome on liquidity in the system. And that itself is not beholden on, okay, who's going to lend this money? Are they going to lend the money? How long is it going to take for those projects to go in? It's really directly money that's flowing to individuals and corporations in real time, and markets broadly. So much quicker feedback loop. Quantitative easing has been the name of the game. We were starting quantitative tightening in theory, right, in the last year. But if you survey most people that are economists and people are watching, there has been almost no reduction in liquidity throughout that period. So there really hasn't been any real quantitative tightening yet. We're starting to see a little bit of it, but it has been very slow. And there's a lot of questions and commentary about why that is or how things have worked. But the Fed has simultaneously been trying to remove liquidity with quantitative tightening while increasing certain liquidity to support the tail and to make sure that there's not a risky tail event. And so they're kind of taking with one hand and giving with the other with some of these reverse repo facilities. There's also liquidity coming because of, more recently from the Treasury General Account, which is not directly from the Fed, as a function of, providing liquidity, emergency lending, right, during this period before the debt ceiling conversation. So there is, in theory, a lot of quantitative tightening coming down the pipe, which is making markets quite nervous because it is a direct effect. And it's starting to operate right at exactly at the time that the lag is starting to kick in on the interest rate piece as well. But it is something important to watch. One of the highest correlations with market performance in the last 20 years has been the Fed's balance sheet itself, and not just interest rates, but broadly liquidity as measured by that balance sheet.
Yeah. You mentioned the conversation. It's certainly a kind way of putting it, around the debt ceiling. I'm curious to hear the importance to you of this idea of the debt ceiling, where Republicans and Democrats stand today, knowing that a lot of this conversation, we've talked about the political implications on the economy, on business cycles, broadly speaking. As Republicans and Democrats try to figure out the debt ceiling, figure out raising the limit, currently at $30+ trillion, what's the significance of this debt ceiling element of the conversation when we're looking at the really big macro picture here?
Yeah, I mean, this is not the first time we've been through this, right? This is kind of a game of chicken that's been used in Congress for quite some time to kind of help pressure certain political messages and really to get through, it's really political posturing. And it's important right now because we're heading into a period, an election, right? A presidential election in the next year. And particularly in a world where we've gone from kind of Republican to Democratic to a mixed house. So there's a lot of brinkmanship, I guess what I would call it, that's likely to happen here in the short term. This will be solved. No incumbent wants to be politically held responsible for a default by the United States government. That is not politically popular. So I'm confident we will come to a conclusion, but there will be lots of political posturing up until the last second. And there will be lots of people trying to brand themselves in a certain way and stand for certain things and try and force certain wins for their side, as part of an agreement that ultimately will come to pass here. That said, I would back up and say, there is a bigger secular trend at play, which is populism. And that's popular in the left and right currently, whether or not the narrative of debt and the amount of debt in the United States and the problems that it faces is less politically popular than it was 10, 15 years ago. And that's true for both sides of the party, primarily because the younger generation, millennials on down, have grown up in a time of where they have been labor and have broadly, they're at 40% of the wealth creation of baby boomers, 40% of the household formation of baby boomers. They can't afford certain things like houses and whatnot. And ultimately that anger is, and desire for a more equitable and fair situation is really the politically dominant, issue of the day. So I don't think that, the question of debt and the problem of debt that we can is really going to be as politically popular. And ultimately, if somebody on the right is trying to stand up for that, even their own party might ultimately find political problems with that. Ultimately, this is not 2010. This is not the party of 15 years ago. And I think that will ultimately play a major role in us getting to a fairly quick resolution.
Yeah, it's certainly an interesting time to be a millennial. It bears repeating. But all right, I think, Jem, we have covered a ton here today. And I have one last question for you before I let you go. I'd love just your super quick take on what's going on in the banking sector. I know that as we're talking about bigger macro stories, this is certainly one that a ton of investors are paying attention to. So could you give me just your quick take on the banking crisis, broadly speaking, and how the Fed and Congress are potentially going to respond to something like this?
Yeah, the problem with banks by definition is they're a leveraged entity with ultimately a tail. They're dependent on deposits, which are short-term lent items, and they generally get matched with slightly, in some form or another, longer-term, almost by definition, longer-term liabilities. Right? If your deposits can leave in a second, every liability you have is longer than a second. Right? So there is ultimately a problem in banks. Period. That's just how a bank is constructed. That's always the case, but we're moving in more and more into a period where it's very quick and easy to move money, right at a time when interest rates are increasing dramatically and deposits are generally paying significantly lower than a money market or a treasury bill. And so there's a direct incentive for people to move money from deposits. While there is an easier technological way to do it, enter weaker entities that can't borrow at the Fed window, and that sit in a generally weaker position. Enter banks in the West Coast where people are more technologically thoughtful and able to kind of move quicker. And then enter a West Coast centralized banking system that is dependent on tech, right? When we've had a significant sell-off in tech and significant layoffs in that area that are also exacerbated by higher interest rates, right? The growth sector is dependent on cheap money to keep funding growth. And as we talked about, the increase of interest rates broadly takes money away from capital in that sector. So you're getting problems, a teetering in real estate out there. You're getting a teetering in the jobs picture in California. You're getting people, a technologically savvy group that's willing to move money and more interested in putting money at higher interest rates, which is leading to capital flight, also exacerbating losses in those particular banks because long-term interest rates have gone higher and their holdings themselves have had some losses, as is true across most banks. And you enter a pretty toxic situation. All of a sudden, you now get speculation against some of these banks, whether it's through options or other things that drive stock prices down. You get panic, and panic ultimately is leading to the demise of these structurally weak players in the market.
All right. Well, that is certainly quite the way to put a bow on this conversation. Jem, I really appreciate your time here today. It's been such an interesting and illuminating conversation. So thank you for your insight and your analysis and for joining me today. I really appreciate it.
Thanks for having me, Kinsey. Pleasure being here.
Of course. And thank you to all of you for listening. We will see you next time. Have a good one.